It is very nice to be with you again. And of course, to have Austin Fitch of Horizon Investments joining us and having a good conversation. We are going to keep this to near TED Talk length for you today. We have 4 topics that we're going to cover, starting with the third rail, which is politics. I always say that when addressing politics, and the presidential election in the United States coming up. We're going to talk about interest rates, the big topic of 2024. That was the big topic of 2023. We're going to talk bond markets and stock markets. So let me welcome Austin Fitch, chartered financial analyst, 13 years now with Horizon Investments. Austin, thanks so much for joining us for our first conversation of 2024 together.
Absolutely. Thanks, Lou, for having me, and excited to get in here and really dive in. There's a lot going on, man.
There's a lot going on, and we've narrowed our focus of time so that everyone can hear some good information and then move on with their day. As always, no charts, graphs, or anything like that. There is a Liverpool football mug involved here, and that is a message. I'm going to my first Premier League football match in England in just a few days. So really looking forward to that. This is what happens, Austin, when you have an English other half. So so let's get to it, all right? And talk U.S. politics. I do get the question frequently in 2024 about how do politics impact, specifically a presidential election, impact the stock market. Why don't you give us the quick on that, how Horizon looks at it? I think there's an interesting number or percentage of time during a presidential election that the markets tend to go up. They don't always go up.
Yeah.
Tend to go up. You can share all that with us if you don't mind.
Yeah, no, I mean, I think it's all super interesting because it's something that we're constantly being hit with here in an election year. And I think what's really interesting, Lou, to a lot of the research that we've done would suggest that markets in an election year may not actually be all that different from markets in a non-election year. Now, I say that on the face of it, that doesn't necessarily mean that it feels that way, right? What we have seen is that traditionally maybe volatility is a little bit higher in an election year, and that maybe shouldn't be surprising because oftentimes there's more headline risk in an election year than a non-election year. Right? And I say headline risk just for folks that maybe aren't familiar with that term. The risk that maybe somebody says something or does something that creates a headline that the market wasn't necessarily expecting. So think about on a political campaign trail, one of the candidates, any candidate says something, whether it's a tax plan, an immigration plan, you name it, like there can be so many different topics that come up that, again, a market wasn't necessarily expecting. In the grand scheme of things, those plans likely don't even get passed as they're being discussed, but the market has to deal with and has to kind of come to grips with the fact that this news has made it to the forefront. So oftentimes you see a little bit more volatility in an election year, but at the end of the year, like I said, the total return on average in an election year relative to a non-election year is like less than 50 basis points different over the last, let's call it 80 plus years at this point, when we can kind of measure an election year relative to markets.
And that is a significant amount of time, 80 years, significant amount of time to have that data, to use that positive, negative of a half of 1% as the impact that it has. Again, I think stating it as the volatility is a great way to frame it. And if I can summarize this way, the incumbent doesn't want to screw the whole thing up by saying, it's all going X, Y, or Z way. And certainly the challenger doesn't want to screw the whole thing up by saying, everything is terrible. This is the worst time. So you really just have, we'll call it kid gloves on either side that are going on. So it shouldn't have much of an impact. Hopefully, the economic data is what really drives things forward or gives us an indication of where we should be heading, which leads into that discussion about rates. Now, I do have to jump on a soapbox, and I don't know if that's the right term to use right now, but I'll jump on it anyway and see if it is. We came into 2022. There was plenty of discussion about interest rates and what should happen with interest rates. That's 2022 I'm talking about, all right? and what should happen with them and where the Fed was going to go with them. We entered 2023 without a question there was going to be a recession. And of course, in 2024, rates had to go down. I mean, everybody knew rates were going down. I'm shouting even a little bit. I'm so worked up about it. And yet here we are in late April of 2024 discussing rates again, and the possibility not only are they not going down, but they could be going up. So give us the horizon framework on interest rates, the impact an increase in rates would have, and if there were a drop in rates, what would that mean?
I mean, I think that's a great way to kind of frame the question, because I think there are a few different paths that we could take from here. And Lou, to your point, I think really anybody in the investment industry, and for that matter, most folks just even on Main Street, were under the assumption that we were going to enter 2024 and start this rate cut cycle, because we had grown accustomed, right, for let's call it almost 15 years, from 2008 to 2000 and at least 2020, if not a little bit further, of basically a zero interest rate environment, right? And then fast forward to your point, 2021, 2022, and all of a sudden rates are at 5%. So then the inevitable question is, okay, at what point do rates come back down? However, one thing I'll point out before we get into expectations for 2024 is what we've done here at Horizon is we've done some backward looking analysis just as to, okay, is this a sustainable environment? We hear a lot of people make the comment, well, this economy can't sustain rates at 5%, or the inflation at 3.5 is going to completely kill this economy. We've actually gone back and, like I said, done a lot of research. If you actually look at the decade of the 1990s, right? The 1990s, the 10-year treasury, or the 2-year treasury interest rate averaged 5.7% for the entire decade. Inflation averaged north of 3% for the entire decade. So this argument that because rates are high, because inflation is a little bit higher than we've grown accustomed, that all of a sudden it's going to be, it's going to be terrible and catastrophic for the economy and for the market. Like, that's just not true. If you look at the economy in the 90s, if you look at the stock market in the 90s, both of those obviously did really, really well. So what we really need to be looking at is the underlying fundamentals. And I will say the Fed, to their credit, to some extent, has actually been following the data pretty well in terms of driving their decisions, which has actually been what's led to the fact that they have not cut rates so far this year. One, right, inflation remains a little bit higher than probably all of us would like it to be. I say that knowing that it's still not, we talked about it for years where it was 5, 6, 7. Shoot, there were parts of the economy where you're seeing, low double-digit inflationary numbers. Like, we're not that high, but you're still a little bit higher than that target. So the Fed probably doesn't necessarily need to cut just yet for that reason. But two, you've got an economy that is growing really well. You've got a consumer that's still pretty healthy. You've got corporate finance world where health is really, really strong. So you've got an environment where we can actually support higher rates for a while. So the Fed's been able to kind of sit back and let that higher for longer trend play out. Now, to your question, okay, so where do we go from here, right? And I think we see a couple of different things. One is if the inflation piece starts to tick back higher, right? If we, for whatever reason, inflation isn't under control and all of a sudden we're hitting 4 or 5% again with some of those inflationary statistics, okay, that's a problem. That's when you likely see the Fed re-engage from a rate hike perspective. I will say this, that's not at Horizon our base case scenario, but also something that's not completely off the table. The more likely scenario is kind of what the Fed's come out and communicated, this higher for longer mantra. And really what that means is they probably won't be cutting rates significantly anytime soon. I think our view is at most, maybe you get a rate cut, maybe you get 2 rate cuts in 2024, but likely it's like an end of year rate cut just to kind of check the box to some extent. But even then, even if you get a rate cut in 2024, or say it's early 2025, you're in an environment where, as we stand right now, the Fed doesn't really need to cut rates significantly, right? Our expectation is that maybe you get 2, 3, maybe 4 rate cuts. And when I say a rate cut, we're talking 25 basis points off kind of that Fed funds rate, to where you would get that kind of that baseline interest rate for the economy somewhere between 3 and 4%. Like if we can get into that range, that's kind of like that Goldilocks scenario. We do not expect a really strong or aggressive rate cut scenario. And the reason there is that would really only happen is if the economy was in like dire need of significant rate cuts. Like remember pre-2008, a normal interest rate environment was where the baseline interest rate was in that 3 to 4% range. And I think our view is that the Fed wants to get back there. So to that point, maybe you see a few rate cuts over the next, 9, 12, 18 months. But like our view right now, as we stand with the strength of the economic data, is you probably only see a handful over the next year or so.
Well, and I think you said it beautifully with the checking of the box. 0.25% rate cut by the Fed is more or less a here you go.
Yeah,
It's really we'll give you this, but we're not giving you more.
Right.
They'll save that tool for when they need to build the economy. If you prop up the economy to start driving rates downward, it's really a double-edged sword, if you will, because when they're doing it, it should be a time and will be a time where they say, oh, by the way, we just had a recession or we're in the middle of one, and now we need to get aggressive, 0.5%, 0.75%. So it's a careful what you wish for kind of thing. Now, a couple of things on this. I brought it up before, but it's always worth talking about when we bring up rates. In 1998, when I bought my second home, my interest rate was 8.5%. And my parents, God bless them, they thought I was the luckiest guy in the world. Like, 8.5%, you got to be kidding me. That's an incredible rate. So I bought that house 6 times in the 22 years that I owned it. Okay. Just as the rates went down. And I will ask you this question. Do you know who the worst predictor of the federal the open market committee's interest rate maneuvers will be? Who is the worst predictor?
I don't know.
Yeah, the Fed themselves are the worst.
I was going to say it's probably somebody that's really close to it, right?
It is the Fed, yes. And that is a Forbes article that was shared with me a while back, and I've shared it with a few folks. I'll try to remember to put it in the notes of this video once it goes out, because it's worth a read. They're the worst predictors of their own interest rate moves upward or downward. All right, so let's jump to the bond market. We just covered rates. The bond market still showing volatility. I would say that it's still showing weakness. Now, I understand your yield could be up, but your value is not correct, or not going up. Where am I struggling with this, Austin? It should be that, shouldn't it be that with higher federal interest rates or Fed interest, the Fed driving the rates higher, that we're seeing bonds, we'll say, stronger in their overall return. But the long bond, the 10 plus year, is really having a hard time. Why is that the case?
Yeah. So there's a lot of things in play there. And Lou, you're absolutely right. Just maybe a piece of data for folks. The long bond over the last 3 years has actually been more volatile than the stock market, which is
unbelievable.
Crazy. Crazy for folks to think about, right? But to your point, that has come on the back of, we lived through, let's call it a bond bull market for almost 30 years. And what we've gone through over the last, let's call it maybe 3 years at this point, is to some extent a reckoning of that bond bull market. And what that has mean for bond prices is you've really seen this reset. And we haven't fully gotten there yet. I think our view there is you're still seeing some of that volatility within bond prices. Now, to your point, today, as opposed to 4 years ago, you're absolutely getting higher yields. So your total return isn't necessarily as negative maybe as it was in 2021, 2022 time period. But you're still seeing that volatility on the price side because there's uncertainty around the future of interest rates, as we just talked about, right? Bond prices really don't probably start to see appreciation within a bond portfolio until you get a meaningful move by the Fed in that downward direction. And as we just talked about, like, that is very uncertain at this point. You could make the case that it may not even be a 2024 conversation. And even in 2025, as we touched on, you may not get much activity in the way of a Fed rate cut cycle. And if that's the case, let's call it 18 months from now, we would expect bond returns to be somewhat back to normal, but almost entirely driven by that yield component and very little price appreciation, just that yield component being what's kind of driving that segment of a client's portfolio.
Okay, well, and that, let me just, I'll say, put you on the spot. I didn't really prepare you for this, but where do bonds belong in a portfolio? Right?
Yeah, we actually had a really interesting conversation just yesterday with another one of the advisors that we work with. And I think there's been this realization within the last 3 years that bonds aren't in aggregate. There are certain bonds in the fixed income environment, but bonds in aggregate are not a risk-free vehicle. And I think for so long they were viewed as, oh, this is the 40% of my portfolio that I put in bonds and it automatically makes me 6%, right? And that's just not the case. Like, we should have never gotten to the point where we viewed it that way. And I think you're seeing this reset where there can be a place in a portfolio for bonds. I'm not suggesting everybody owns 100% equities by any stretch, but I also think we have to understand that there absolutely is volatility in that space. So that leads to a conversation of, okay, so then how should we think about diversification, right? Maybe it's not just equity and fixed income, where the equity was the risky part and the bonds were the safety net. Maybe it's more equity. Maybe it's a little bit of risk mitigation. Maybe it's, there are a lot of different types of products that have come out. They're a little bit more alternative, whether they use options or they use different structures in place where you can think about kind of that risk mitigation approach where you're not getting full blown equity exposure, but you're also not getting, the interest rate kind of volatility that you're getting in the bond space. Now you're getting kind of a mix in the middle. And I think our view is that for a lot of clients, especially those maybe that are nearing retirement or getting into that kind of stage where they're trying to preserve assets, is it's a mix of multiple different types of investments. It's not just what used to be stocks and bonds. Maybe there's more of that risk mitigation or that alternative exposure where you're using something that's not, again, what people thought was a risk-free asset, but in reality isn't necessarily risk-free.
Well, never has been. And that lesson came to me in 1996 when there was a bond meltdown. And I went to my mentor, Barry, and said, what are you talking about, a bond meltdown? They're bonds.
Right.
And he said, well, sit down, son. Let's have a conversation. So I've understood it the whole way through. So we got on a little tangent there. I will touch on it that I would love to talk to everyone about the different theories at work at Tranquilli Financial Advisor. And I drive all the investment firms crazy because no one gets all of the money. I always say you can put all your eggs in our basket because we're not putting all of client eggs in a basket. We use different theories because at different times, Horizon is more correct than others, and others are at times more. So it's not only risk mitigation, but it's also theory diversification as well. So with that, onto the stock market. We'll wrap it up right here. If you don't mind, a little bit of a forecast, and don't worry, no one is holding it to you. We don't want any guarantees because we don't want the SEC breaking down the door or anything like that. But as you see it at Horizon during your discussions about what do stocks look like for the remainder of 2024, and of course we'll update this again after the summer. This is going to kick off our 2024 summer series with investment firms. So give us the Horizon outlook on the stock market, please. Yeah,
I would tell you, Lou, that we're still fairly optimistic about the market in general, the economy at large. I think what we saw in the first quarter clearly got a little bit ahead of itself from a market standpoint. We've seen that even in the last, call it 30 days at this point, right? Stock markets were up low double digits in the first 3 months of the year, right? And I think we're all probably smart enough and have been around long enough to know that we didn't expect the market to go up 40% in 2023, right? It's not going to go up 10% every quarter. So it makes sense that there has been a pullback just in the last few weeks. That being said, we still think the underlying fundamentals that you're seeing from an economy standpoint suggest that growth should continue, suggest that stocks should continue to rebound as we head into the remainder of the year. And what that means for us, again, just looking at the full year, is probably a high single digit, low double digit type of return for stocks really across the board. Now, yes, there are going to be parts of the economy, there are going to be parts of the market maybe that do better than that. There are going to be other parts that come under a little bit more pressure, have a little bit more headwind. But at the core of it, really what it boils down to, and we've touched on this a couple of times, you've got a consumer in the US today that is as healthy as they've been in the last 30 to 40 years, just from like a personal balance sheet standpoint. And you talked about the idea of like refinancing a mortgage. I will say this, the consumer at large actually acted very rationally from, let's call it 2010 to 2020, in terms of taking leverage off the table, refinancing debt, putting themselves in a really strong place so that as we're coming through COVID, coming out of COVID, you actually have a consumer that's still financially really healthy. You saw the same thing on the corporate side, whether it was, locking in those low interest rates to finance projects for long periods of time from a capital expenditure standpoint, whether it's, setting aside money that for future projects. Like, you've had a really healthy environment. And like I said, they took advantage of kind of that low interest rate environment that has the economy positioned well for continued growth. Now, yes, there will be headwinds. There will be things that pop up. We talked about the election, some of the headline stuff that's going to come up. Like, those are things that are not going to make this next, let's call it 8 months, like all rainbows and butterflies. But it's also the underlying kind of underpinnings of the economy continue to suggest that we have some room left to run from that standpoint. I think our view at Horizon is that you don't see a recession in calendar year 2024. And for that matter, if you do see one in 2025, it's probably the latter half of the year. We think there's enough kind of juice left in the economy that persists for the next, call it 12 to potentially even 18 months. Just given the strength of what we see today.
Nice. All right. Well, that's encouraging. Appreciated. And he is Austin Fitch, Chartered Financial Analyst, Horizon Investments. He is the head of Consulting Solutions. And I know I appreciate it every time, Austin. I get plenty of feedback. It's always good. So well done on your part. And thanks again for joining us.
Absolutely. Thanks for having me, Lou.
Of course.
This webinar was created in 2024 and is provided by Horizon Investments, LLC, and Tranquilli Financial Advisor, LLC, for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisors reserve the right to modify their current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk Assist is not a guarantee against loss or declines in the value of your portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when Risk Assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have Risk Assist feature. While Risk Assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that Risk Assist will always limit drawdown as designed. Accounts with Risk Assist are not fully protected against loss.